Ladies and gentlemen, welcome to Destination Retirement with Robert Kuhn.
Time to get on board with Robert Kuhn from Kuhn Capital Partners. Retirement is a destination you've spent decades saving for. And what you do with those savings can make all the difference in the life you live once you get there. Income planning, wealth planning, tax planning. Destination Retirement with Robert Kuhn starts right now.
Welcome. I want to thank everybody for joining us today. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, independent registered investment advisory firm. Please reach out, set some time up on our calendar, 630-492-1912, 630-492-1912. We had some great dinners this week. As you know, we're big proponents of banknotes and structured banknotes offered by the largest banks. Last week, we did a banknote 13% with 30% downside protection. What that means is if the indexes the note is tracking are not down to 30%, you're going to get an annualized yield of 13% paid monthly. So think about that. You have 30% downside to still have positive returns. And again, that is what we're talking about, strategies that can greatly reduce volatility and still allow you, even in negative markets to negative 30, to still produce positive returns for some of your money. I would say that is probably the number one reason most individuals reach out. And we're going to continue to educate. We're going to continue to talk about those types of strategies. It's not new. It's not cutting edge by any stretch of the imagination. Most retail advisors, however, we classify as advisors that advise on assets anywhere from $500,000 to generally $10 million. They just don't have or include defined outcome strategies the bulk of the time. We see it. We talk to the providers of these strategies, and it's unfortunate because people want clarity. People want certainty for some money, or at least they want the rules of the road going in. So if you don't have that, reach out 630-492-1912. Let's talk about financial planning. We don't talk about financial planning enough on the radio show. As you know, we are a financial planning firm. We're very forward-looking when it comes to financial planning. We are laser-focused on tax reduction strategies. Again, the most overlooked area, in my opinion, of financial planning is tax management. And we're not talking about maximizing or not maximizing, but we're not talking about matching gains with losses and tax loss harvesting. You would think that would just be kind of an automatic, but would you believe it that advisors are actually holding themselves out as forward-thinking, proactive tax managers, tax reduction managers, because they're doing that? We are talking about greatly reducing your taxable income, $80,000, $90,000 per $100,000 invested in our energy fund. To me, that is tax planning. And one of the things about financial planning is very, very interesting topic in the financial services industry. Generally, you're going to get a plan when you're looking at making change. And we're going to talk about making change today. I want to definitely talk about that because change is really second nature to us. We see change generally, almost every week with new clients, and they come from other advisors. They come from, firms that, or if they're managing the money on their own. We understand that change is hard, and our job is to really quantify why you making that change is good or bad. And as you know, we are not in any way pushy. Our job is to educate. Our job is to be very realistic about what you have and then allow you to make a decision. So financial planning is generally done extensively at the start of a relationship, and then it's really, kind of an afterthought, going forward. And we have really made a concerted effort as a firm to not be that way. We used to be. And our job, when it comes to financial planning, we think it's critical. We think it's critical for individuals because what it does is it creates a clear roadmap to achieve both short-term needs, long-term goals, whether that's retiring comfortably, minimizing taxes, paying for college, leaving a legacy. And truly, without a plan, people often react emotionally to market swings. They overspend, or they miss out, candidly, on major opportunities. And a sound financial plan will bring structure. It will bring confidence to the decision-making process, and it really helps individuals make smarter use of their income and their investments while they're preparing for, really life's inevitable surprises, because ultimately they are going to happen. And the truth about a financial plan is we are going to give that to you complimentary. And what that does is that shows the level of planning that we go to. So we have traditional financial planning software, and we also have tax planning software. We can get as granular as making sure that if you are taking Medicare, that we're not bumping you up into another IRMAA bracket. I mean, the financial planning and the level of detail that we go to is very, very uncommon, and it's very unusual in the industry. But we believe that it is the most critical area of kind of just, sound decision making. And, we could probably charge $2,500 for that financial plan, and I bet you there are many people listening on the radio today that would pay that. And we do that complimentary. It's really an investment of our time. It's an investment of our time because if we adhere to the fact that we are here to not push our agenda, we are here to push the investor's agenda, I don't want to say we're trying to radically change the industry, but we kind of are. And it's not, I think about it a lot because sometimes when you're trying to change an industry and change the way that investment advice is given, that means that we're doing something so outside of the course of normal business that, some people could, question that. And this is not that. This is just we're taking a couple financial plans and tax plans and stress tests that we can give you on your current portfolio, and then really giving you the knowledge, arming you with the knowledge to confirm, your thoughts. There's a lot of people that we speak with. We do a lot of dinners, obviously, that we do the radio show, and so we are lucky enough to talk to investors of all types, investors with $500,000, investors with $10 to $15 to $20 million, and everybody in between. And we are very, very lucky to, just hear kind of what the core of their concerns are today. And it is very, very interesting. Most individuals are fearful that, they don't have a plan. And what most advisors are going to hold the financial plan out as is really trying to determine if your resources will allow you first allow you to spend what you want in retirement, and that your resources will last, for your life expectancy. Most people intuitively already know that. I mean, so you look at the Monte Carlo analysis, you look at the probability analysis. I mean, that is just the very, very tip of a financial plan. I mean, generally speaking, you're not coming to us, trying to determine if, your assets will last. Most individuals, kind of just like I mentioned, intuitively know that I can spend X based upon what I have. The financial plan is just so much more than that. How can we reduce your lifetime taxes? How can we reduce your lifetime taxes? I can't tell you how many advisors are missing the boat, how many tax CPAs are missing the boat on Roth conversions. And again, our job isn't to tell you that it's right or wrong. Our job is to lay out the data because there's, the data is what the data is. So 630-492-1912, 630-492-1912. But when we look at what the financial plan does, we look at lifetime taxes. We look at taxes year over year. We look at wealth transfer. And you don't have to have millions and millions and millions of dollars to want to leave a legacy. I mean, your legacy is your legacy, whether it's $1 or whether it's $20 million, it just doesn't matter. And we are very, very pleased and very, very proud that we're going to help investors no matter what asset base you have. Now, the 10 to 15 to $20 million investor, they may think that we don't, focus on that area and we don't have strategies for those investors, and that couldn't be further from the truth. Truth be told, that the more money you have, the more opportunity you have, but yet we see the higher net worth investors just investing as if they have, $100,000, and the advisors are holding themselves out as, something cutting edge, something, that's totally unique in the industry, and it's just not the case. And so we look at, we're laser focused on taxes. We're laser focused on tax reduction. And there are so many individuals all over the United States. And again, we have a national client base, albeit that we're, headquartered in the Chicago area. But there are so many individuals that the bulk of their assets are in IRAs, not Roth IRAs, but IRAs. And the advisors have not done a good enough job of explaining, if you have a seven-figure IRA or a multi-seven-figure IRA or a larger IRA, and you have any kind of assumed growth in that portfolio, your lifetime taxes, if we run your life expectancy to 90 or 95, the amount of taxes that you're going to be forced to pay based upon RMDs is staggering. The thought of, we're going to be in a lower tax bracket, we're going to take money out at a lower tax bracket because I'm not working, that could be the case, but it's probably not going to be the case if you have a larger IRA. And part of our financial planning process is really to model out your, every single year of your life expectancy, the RMDs, which are going to have to pay. Even if you're in your 60s, even if you're in your 50s, you're going to have to pay. And we've seen it where you have a seven-figure or multi-seven-figure IRA, you're going to pay, if you live to 90, 95, $2 to $3 million in taxes. And by just some very basic proper planning and the utilization of a Roth, where most people think they can't utilize or it doesn't make sense, we could save you a couple $1 million on lifetime taxes. And those are the things that we're really proud to show individuals. So if you have any interest in financial planning, if you haven't done a financial plan, if you haven't had it updated, make sure you reach out 630-492-1912, 630-492-1912. We'll talk about stress testing your portfolio after the break.
Planning for retirement is kind of like planning for a trip of a lifetime. First, you save and plan every detail. Then comes a day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-429-1912 and visit our website, kuhncp.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, also the host of this radio show, Destination Retirement. Banknotes, you know that we're a big proponent of banknotes, defined outcome, including strategies that can deliver positive returns even in negative markets to a point. Pricing currently on the banknotes, you know that we did a JP Morgan banknote that paid came in at 15.45% annually. We did that a few weeks ago. That was very high. I doubt we'll see anything close to that again unless we see, the market volatility that we experienced in April. The banknotes really address those concerns when you can still get, the last one we priced was 13%. So when you can get 13% annually paid monthly, as long as those those indexes that note tracks don't go down 30%, that really addresses the whole low growth stagflation potential outcome of the markets, which many people are, starting to talk about. So if you have any interest in that, 630-492-1912. Again, it's not new. It's not cutting edge. I mean, my goodness, these strategies have been around since, I started utilizing these strategies in the early 2000s. Today, the minimums are only $1,000 to add to a note. It's just most advisors don't do them. It generally is a higher net worth family office, institutional type strategy. It's not something that's marketed, but it is a massive market, few $100 billion a year. So again, if you do not have strategies in your portfolio that you know the rules of the road, that you know even if the markets are down to 30%, that you can still deliver positive returns for some of your money, have a conversation, 630-492-1912, 630-492-1912. Because again, look at the bond strategy, look at the bond market, pick your favorite bond fund, aggregate bond fund. And most 10-year bond funds are going to annualize under 2%. So that is tough. Very, 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 very tough in this market. So, those are the things that we're talking about. Those are the things that we're bringing our clients. Those are the things that we're bringing, new clients that come to work with us. We are not bashful about letting you know that most advisors simply do not add any value. Most advisors are investing their own money differently than they're recommending to you. Think about that. That has to be a very, very new concept and new thought to you. Most advisors are recommending, balanced portfolios, buy and hold strategies, just more of the basic generic type stuff that's been around for decades and decades and decades. Why are they doing that? Because it's easy for them to scale a business. It's easy for them to scale a business and see their revenue go up and to the right. And then when the markets do what they did in April, it really just is, hey, don't worry about it. It's ultimately going to be fine. Markets come back. Nobody is debating that the markets come back. I mean, the math tells us the markets have only been down 16 times since 1950. 16 times since 1950. But a good advisor, a pro of an advisor, is going to be able to deliver positive returns in those negative markets. It's about compounding your money. The greatest way to compound your money is to try to avoid losses. Advisors talk it. They talk it nonstop. They talk about diversification. They talk about bonds. They talk about this, but yet that doesn't cut it. That's not, I will compare that against the banknotes any day of the week. Think about this. You're getting an investment backed by the largest financial banks in the world, and you're going to be able to deliver positive returns if the markets are not down 30%. So one of the greatest ways to recognize the value of an advisor, and again, we talked about financial planning, we talked about Roth conversions, we talked about in the first segment what the financial plan is and how do we utilize it. And we're going to talk about annuities again today, and I'm going to get on my soapbox because I see it far, far, far too much, these lifetime income annuities being sold incorrectly. They're not bought, they are sold, believe me. You're getting convinced to buy them. It's not something that you're just reaching out to individual advisors to buy. You're being sold those. But the stress testing software that we have, generally it's cost prohibitive for individuals to utilize. We're all about education, laying the facts. That's it, laying the facts, getting you comfortable with either confirming that you, A, have a great portfolio, your advisor is cutting edge, or B, that your advisor isn't bringing you any value and you're just, tracking the market up and tracking the market down. And I would say 9 out of 10 stress tests that we run for individuals, again, it's complimentary, will just show that. It'll show your advisor absolutely is not bringing any value to the table. If the markets are up, you're great. If the markets are down, you're going to lose money. And you have to go back to that chart that we talk an awful lot about during our dinners. And if we've talked personally before, I'm sure I've shared it with you. The markets go up, like I mentioned earlier, 16 times out of since 1950, they've only been negative. That's it, 16 times. So yes, nobody's debating that the markets go up over time. That's not a discussion that's even worth having. We know that to be fact. But does that mean that those 16 times that you shouldn't have strategies that can offset those losses that your equities are going to experience? And, we just see it far, far too much. So the portfolio stress test is so essential, I think, especially in this market. If you're in your 50s, in your 60s, retired, it's so critical to have that portfolio stress test done. Portfolio stress testing truly is essential for individuals because what it does is it reveals how your investment portfolio might perform under extreme market conditions like recessions, inflation spikes, market crashes, tariff issues, oil crashes, spikes. I think there's over 100 different market conditions, both good and bad, that we can run your current portfolio from and give you a report. And then you can decide the value of what your advisor, what your strategy is bringing to the table. Most portfolios look fine in a bull market. I see very, very few people that come to us when the markets are up 20 to 30% and they say, yeah, you know what, I really want to make more money. Now, we do too, but people generally don't make change because they're not making enough money. Albeit, I guess I really need to kind of think about that statement, because I can't tell you how many people have missed out on the market because their advisors were too conservative or they had too much money weighted to the bond strategies. And obviously we're in the worst 5-year period in history in the bond market. So maybe I am contradicting myself a little bit. And but, again, generally speaking, most portfolios look fine in a bull market, or individuals overlook, the negatives in a bull market because hopefully their equities are performing well. But stress testing exposes hidden risks that could derail your retirement plans or create cash flow issues. Again, we work with everybody, generally $500,000 or more, but we work with most investors. Our sweet spot is kind of in that $1 to $15 million mark of kind of the strategies that are most appropriate for. And you need those stress tests. I mean, my goodness, you need those stress tests. We're going to tell you about a story here in a minute with a $12 million investor that we talked with this week. But we have to make sure that the market, at best, we think is going to be very volatile. We are seeing many firms say that we could retest the bottoms. The reality is, I don't know. Your advisor doesn't know. You don't know. Markets don't care what I think, what you think, what other advisors think. They're just going to do what they're going to do. And given that they are so, algorithmically driven, that the markets are interesting and they just continue to be interesting. And it's, somewhat concerning to see, what's going on in the world. But it's about playing defense before you need it. And that is what I think stress testing is about, playing defense before you need it. It's showing you, and not what your advisor says, not what I say. It's showing you how well your portfolio would handle in extreme market scenarios. So we want to make sure that we're playing defense before you need it. And we have to identify vulnerabilities. We have to identify, issues inside of your portfolio so we can make adjustments to reduce downside risk, improve diversification, and ultimately invest with greater confidence and resilience. I think that is the job of an advisor, is to make sure that we are crafting portfolios that allow you greater confidence and just creating a more resilient portfolio. And I keep going back to those banknotes, and I understand it. I repeat myself over and over again. But there are many people that would take double-digit returns, sometimes 15, sometimes 13, sometimes 14, sometimes 12. Really, it's dependent upon, the volatility in the market as far as what the notes price at. But these are guaranteed. They're a prospectus item, guaranteed. It says it in the prospectus item, guaranteed by the bank. But I cannot tell you the peace of mind, the comfort, the resilience that you add, even if you just add 25% of your portfolio in a strategy that can still deliver double-digit returns paid monthly, as long as the indexes that note tracks are not down 30%. I mean, think about that. If that's the only thing you do is add 25% of your portfolio, which may be high, may be low. I mean, everybody's situation is totally different, totally unique, and we get that, and we have to make sure that, we are having those conversations. But when you can have a large bucket of your money that can still deliver positive returns on a annual basis, paid monthly with 30% downside protection, the comfort that it brings, I see the lights, people's eyes light up. And inevitably what they're going to always ask is, why doesn't everybody do this? And you know what? That's shame on the industry. And candidly, they're just a lot of work. They are a lot of work, and they don't pay a commission. They are a tremendous amount of work, because these banknotes generally are going to get called pretty often. When the markets are up, they're getting called every 6 months. If the markets are down, we may own it for 8 months. We may own it for 12 months. We may own it for 18 months. Who knows? 24 months. Reach out if you want to learn more about that stress test. The biggest problem is just get us what you own. I don't care if you send statements. We can't do anything with the statements anyways. Spreadsheet what you have, Excel spreadsheet what you have. I don't care. Just get us the investments. We'll run it complimentary, and then we'll spend some time going over it. So 630-492-1912, 630-492-1912. Reach out, get on our calendar. We'll have that conversation. More after the break. Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, independent registered investment advisory firm. We are bringing our clients, we are bringing investors strategies that can deliver positive returns in negative markets. It's simple. Investing is simple. Lose less when the markets are down. I challenge you. If you're working with another advisor, if you're working or managing the money on your own, call your advisor, ask yourself the following question. What do I own that will deliver positive returns even if the market is down? Can't be bonds. It cannot be bonds because that is not bonds can be down. I guess it can be. That could be an answer, but then you simply ask what the yield is, and that's going to be a real challenge. But I want to know, you need to know what bucket of your money can go and can deliver positive returns even if the markets are down. The banknotes, we use banknotes, down 30%, you're still getting positive returns. As long as the index is not down 30%, you're getting positive returns. Generally, we're pricing notes by the biggest banks at 12, 13, 14%. If you do not have them, you need to look at them. If we are in a low growth environment, if we're in a stagflation environment, if we're in a high inflationary environment, these notes for a bucket of your money, for an allocation of your portfolio, could be the portfolio savior. So 630-492-1912, 630-492-1912. Reach out, get on our calendar. Let's have a conversation. A couple of things I want to talk about this segment. We're going to talk about annuities. We're going to talk about annuities. I love talking about these lifetime income annuities and really kind of giving you the true education, because people's eyes, I mean, my goodness, their mouth almost opens up once I explain to them what they really own versus what they were sold. So we're going to spend a little bit of time talking about that this segment. And I also want to talk about why the higher net worth investors invest differently than the average client, the average investor. And it's when you look at, we have a chart in our presentations. If we meet, we have a chart that we'll certainly go over. When you look at family offices, and you look at some research that was done recently by UBS that looked at family office asset allocation. And what a family office is, generally speaking, there's one client, the family. I mean, that is it. You're managing the family's money. There are smaller family offices, of course, but generally it's $50 million and above, and it gets to the billions relatively quickly. But we look at what they're doing versus what the individual investor is not doing. We classify an individual investor, well, the industry says retail, but we just classify the average investor, kind of someone who has $500,000 to kind of $15 million of investable assets. That's what we classify the average investor in. The way that the higher net worth invests is significantly different. As far as the latest research that I've seen in the family office space, they're going to have 50-ish percent, 55-ish percent in what you would classify as traditional assets, and they're going to have 40, 42, 45% in what they would classify as alternative. Basically, what an alternative is it's just not a stock or a bond. I mean, the fact that, it has an alternative name, that's not something that is should be looked at negatively. I mean, it's phenomenal. But what are they doing? Why are their returns, at least the research, the data that we see, statistically always or more times than not better than individuals? And I don't think it's necessarily when the markets are up. I think they have strategies. Well, I know if you believe the research that they have strategies that can, again, deliver positive returns in negative markets, i.e. the banknotes, private equity, commodities, hedge funds, absolute return strategies. There's a plethora of different strategies. So I want to step back and we really try to talk about this. We really try to educate. And why is it important? Because the bulk of the strategies that you once, again, the average investor could not attain, those minimums, most individuals can now attain them. And that's the beauty of it. in that with the use of technology, the advancement rather of technology, these strategies are now attainable for most individual investors, generally $500,000 and up. The high net worth always, well, at least it's my experience, they do a few things differently than the average retail investor. And it's not just about having more money. They prioritize tax efficiency, often using strategies that can greatly reduce their taxable income. They use private placement strategies. They look in the energy space to reduce taxable income. That is so key in today's world. They demand institutional grade access, investing in private equity, hedge funds, structured notes, direct deals, retail investors rarely see. And like I mentioned earlier, they stress test their portfolios. They build in downside protection. They build in strategies like the banknotes that can still deliver positive returns in negative markets. And generally, they work with fiduciaries who think strategically, not just sell product. And most importantly, they treat investing like a business. That is the main difference that I see. The more money you have, the investment becomes a business. They're data-driven, proactive, and focused on net return. Net return, not just market performance. Think about that, net return. If you have a strategy, if your manager, most people don't even talk about this, but if you're, unfortunately, most individual investors don't even know how to quantify whether they have a good advisor or they don't. That's one of the reasons that we do the stress test. And what we will do in the stress test is we will stress test your current portfolio, the fees, the economic shocks, what it would do, and then the returns, and then benchmark that to the indexes. The indexes are what you can get without paying a fee. And I have a news flash for you. When you look at fees over time, man, do they add up if you're not getting any value. Our equity strategy, one of our core equity strategies. Now I'm going to preface this by saying, past performance isn't indicative of future results. You don't make investment decisions based solely on returns. I want to make sure that, we try to be radically transparent on all of the things that you need to understand. That said, our core equity strategy that we use is third party. So it is third party. They're constantly ranked in the top 3 to 5% of all like managers. They've been running money, this strategy since 1995. And when you look at their performance, so it's just a little bit over 12.5% as of the latest performance that I've seen. And it's probably still there, just, down a little bit in April and then back up. Versus the S&P. The S&P at just over 10.5%. So you're looking at about 1.5% outperformance of the S&P. May not seem like a lot, right? What's 1.5% a year? Well, over time, let me share what it is for you. You look at what that has done, 1.5%, 1.75% of the S&P since 1995 on average. You're looking at 1,200% cumulative outperformance. 1,200% cumulative outperformance of the S&P. So yes, performance matters. Yes, stock picking matters. Index strategies, most people don't think are going to do as well as they once have. Those advisors that tell you they can't outperform the market, those advisors or the Wall Street that tells you can't outperform the market, that is factually inaccurate. So if you are paying an advisor 1%, 1.5%, and you're not getting any value, think about the money that you're leaving on the table. We're going to shine a light on performance. It's a competitive advantage that we have. Again, past performance doesn't mean anything about the future. It's not indicative of future results. We have to always make sure that you fully understand that because it's important. It is very, 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 very important. But, there are strategies that historically, long-term, that are quantitative in nature, mathematical. That is what the market is today, mathematical. That is what it is. Algorithms rule the market. If you're not taking advantage of those strategies, you are missing out. 630-492-1912. 630-492-1912. If you're working with an advisor that talks about balanced portfolios, some equities, some bonds, you might as well, be back in the 1980s. And you're leaving so much to chance that there just could be some issues. And we want to make sure, again, higher net worth. They look at it as a business. They look at investing as a business. Why should you, at $500,000, $3 million, $5 million, $10 million, whatever that number is, why should you not look at it as a business as well? Again, pick your favorite sport. You are the team owner. You are the team owner. We are the general managers. We are the managers that are going to hire if you look at football, the offensive coordinator, the defensive coordinator, the special teams coordinator, the O-line, the D-line coaches. Those are the things that we do. We can look at things differently than you can, not because we're smarter. Please don't take that as what I'm saying. I think investing is rather easy, but I've also done it for 30 years. And so we've been able to provide financial advice for an extended period of time. So we just have a very, very long head start. And we've seen things. We've seen things that have worked. We've seen things that haven't worked. So we prioritize tax efficiency. We prioritize minimizing lifetime income tax. I am just amazed that advisors have not run a lifetime expectation of what your RMDs are going to be to your life expectancy or age 90 or age 95 and give you, as the tax law states today, what you can expect to pay in lifetime taxes and then how much money is going to go to the heirs. It's amazing to me. And when you look at, the power of the Roth, you just don't fully grasp just how much it's going to save you in lifetime income taxes. And it is, in my opinion, the single best wealth transfer story that people can let it grow. Inherited Roth can grow for 10 years tax-free. All of the gains are then going to be taken out tax-free. It's just a mistake. It's a misnomer that the more money you have, that you may not be able to contribute to a Roth because you make too much money, or you may think that by converting your IRA to a Roth is going to not be smart based upon taxes. Well, we're here to challenge that thought. And if your advisor hasn't done that, get with us and run that Roth conversion plan. We will show you if it works or if it doesn't work. We will show you how much money you can save in lifetime income taxes. And we've seen it many, many times. If you have a 7-figure IRA or a multiple 7-figure IRA, and we're running out to life expectancies to age 90 to age 95, and you may pay $3 million in taxes just from your RMD requirements. I mean, think about that. Just from your RMD requirements, you may pay multiple millions of dollars in taxes. Well, by doing some basic mathematics and running some basic Roth conversions over a 5 to 10 year period, what if we could reduce that to $1 million or $500,000 or something significantly less? So those are the things that we want you to start thinking about. Those are the things that we want to start having conversations about. And we'll do it complimentary. It doesn't cost you a penny. It's a cost of our time. But again, it's very important because if you're not a client and we're going to that level of detail and we are running and utilizing tax software that most advisors don't have access to, if you're with a big bank or you're with a big brokerage firm, generally they won't even let their advisors use that software, which is shocking to me. But let us show you that. Let us show you how we can greatly reduce your taxable income, how we can greatly reduce the tax that you pay. And you may not want to leave a penny to your heirs, not a penny. Okay, fine. Then it's going to give you more money during your lifetime. And if you happen to want to leave money to your heirs, there is, in my opinion, not a single better strategy than the Roth. Because the IRAs that you're going to leave, you probably haven't been shown what a tax nightmare that is going to be to individuals. And we're here to show you, and we're here to really, really focus on that. So 630-492-1912, set a conversation up with our team, and we will certainly go over that. 630-492-1912. We'll talk about annuities after the break.
Planning for retirement is kind of like planning for the trip of a lifetime. First, you save and plan every detail. Then comes the day you've looked forward to for so long. Preparation is the foundation for successful travel and retirement. At Kuhn Capital Partners, we believe that foundation is a financially secure and tax-efficient plan that seeks to protect your needs now while looking to the future. Reach out to Robert Kuhn at 630-492-1912 and visit our website, kuhncp.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners. If you'd like to have a conversation with us this week, call Jenny or Paige, and they can certainly set that up and get you on our calendar, 630-492-1912, 630-492-1912. If you want to learn about the banknotes in a little bit more detail, we also do have a webinar that you can call in and get the link sent to you. Our energy strategy, which is our tax reduction strategy. Again, when you look at energy, there's a couple ways that you can invest in that. Certainly buy the common stock of the energy companies, the Exxon, Chevrons, Conocos, Occidentals of the world, and get a coupon or a dividend rather. No tax benefits come with just simply investing in that. Or if you'd like the tax benefits, you can actually invest directly alongside of those companies in their projects that they're doing. And it's very, very simple. Any revenue that they generate, they are forced to, because we own that interest, that we get 3% of that revenue. So the beauty of it is you get significant tax benefits. At $60 oil, $65 oil, we're very confident and target a 2-to-1 at exit. I promise you, if you're at a big bank, a big brokerage firm, you are not hearing these tax reduction strategies. That is what the higher net worth does. That they prioritize tax mitigation, and that is a very, very core component of what it is that we do on a daily and weekly basis for individual investors. So 630-492-1912, 630-492-1912. We also have a webinar on that, 15, 20 minutes. I think that one might be a little bit longer, 25 to 30 minutes. Listen to it, watch the whole thing, whatever. But if you have any interest in the banknotes and you want to watch that webinar, just give our team a call and ask them. They'll send you the link. And if you have any interest in the tax reduction energy strategy, they'll do that as well. So let's finish up this show talking about annuities. And we see, and we've met with so many people that have been sold, went to a dinner and have, the dinner, or called in, from the radio show, because, would it surprise you that my opinion, my belief is the bulk of these radio shows on the radio are just nothing but an annuity sales pitch. You may not catch it, but that's what it is, because that's what they do almost exclusively. Or you go to a dinner, and it's, billed as a financial planning dinner, as a risk mitigation dinner, but it's nothing more than an annuity. I'm sure if you're a higher net worth, if you have live in a higher zip code, you've gotten those invites. And listen, we send them out too. But we just have an educational dinner that talks about everything, pros and cons. We're not just here to pitch annuities. Some of the stories that I've heard about those that pitch annuities, it is mind-numbing to me. Met with a client. He did become a client, but a new investor from one of our dinners that they put 85% of their net worth in a lifetime income annuity. I just could not understand that. And I could not for the life of me understand that. And when you look at these lifetime income annuities, again, we think there's a place. Generally speaking, we have found, investors under $500,000, it could be a very, very good strategy. I think there's much better ways to generate significantly more cash flow than a lifetime income annuity. But, it is what it is. And you have to understand what you're buying. I see far too many people say, I'm guaranteed 7%, I'm guaranteed 8%. I get a bonus of free money of 30%, of 40%. Listen, there is no free money. That may be how you're sold, and maybe that was what the advisor, the agent told you, but that's not reality. And when you look at these roll-ups, the 7%, 8% that you're hearing about, that's just on your income base. That has nothing to do with real cash value, real investable dollars, walk-away money. And so I want you to understand that there are probably no better phrases than guaranteed lifetime income. Guaranteed lifetime income. Those are very, very strong, three powerful words, but you have to look at what you're getting. What is that? And when you get that guaranteed lifetime income, do you realize that you are just taking your own money out of that account until the account goes to zero? That's it. Your own money out of that account until the account goes to zero. So if you're in stocks, hypothetically, and your account goes to zero, yes, your income stops. There's no more money. If you're in a lifetime income annuity and the account goes to zero, well, yeah, your income continues for life. But you have to understand, what is the insurance company doing to hedge that risk that they don't have to pay that money? Because that's when you go into the insurance company's pockets, that's when your account goes to zero. I have to think actuarially, they know that's never going to happen, or very, very rarely is that going to happen. And a couple ways that they're hedging against that happening are really simple. They give you a little bit of growth, 2%, 3%, 5%, 4%. Now, I get it. Illustrations will show 12, 13, 14%. If you are thinking of that, if you're thinking of buying one, call me. We will show you the real performance, not the back-tested performance, the real performance, because those illustrations can show the back-tested performance. We will show the real performance. And so the insurance companies hedge by the amount of growth that they're going to give you. They're going to give you just enough growth, right? And then the biggest hedge is they're going to limit the withdrawals. They're going to limit how much money you can take out. 4%, 5%, 6%, 7%. That's the governor. And that's almost statistically the probability of the account going to zero. That's how it's just not going to happen in most situations. So what you're doing is you're really just bleeding your own account to a significantly lower value for a benefit that you're probably not going to take advantage of. And then the biggest problem is, what does that distribution, what does that guaranteed withdrawal amount do? How much is that affected by inflation? 5 years, 10 years. So you put in $1 million in a guaranteed lifetime income annuity, and you're taking out, I don't know, $100,000 a year, right? That's going to stay at $100,000 a year for the rest of your life. I don't care what that illustration shows that you can get a raise. In the real world, it's not happening. It is not happening. So what does that do to your purchasing power 5, 10, 15, 20 years down the road? What is that $100,000 really buying you? I mean, we've seen it. I mean, if you need, in 10 years, if you're taking out 100,000, I think conservatively, you really need to be taking out 150 to 160,000 just to keep up with, or keep that same purchasing power. So again, we're going to hit these and continue to hit these. You can't say that we don't like annuities. One of our protected growth strategies is exactly an annuity. It just doesn't have a lifetime income component. It's a 5-year annuity, guaranteed against loss each year. Your worst year is zero, and it's tied to the S&P 500. That is it. Currently, you get the first 10%, not including dividends, of the S&P 500. So 0 to 10%, you get 100% of that return. Nothing on the downside. That appeals to a lot of people. That appeals to a ton of people for some safe money, to some, hedge away risk of your portfolio. You hedge every area of your life in most instances: car insurance, home insurance, auto insurance, health insurance, life insurance, et cetera, et cetera, et cetera. But most individuals don't have anything inside of their portfolio that is a hedge to a down market. That's why we use that 5-year annuity. So when we look at protected growth, we look at hedge strategies. The bank note is exactly that: 13%, 12%, 14%, whatever that note is, with 30% downside protection before you don't get paid. If you want to talk about Roth conversions, minimizing those taxes, looking at lifetime, taxable income or taxes that you're going to have to pay, we'll do it for you. So all you have to do is reach out, 630-492-1912, 630-492-1912. Set some time up on our calendar, and we'll certainly go down that path with you. So hope everybody has a great weekend. More next week.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guest unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.